All right. Good morning, ladies and gentlemen. Thank you so much for joining us today. We have an extraordinary special guest today. We here at the Florida Association of Mortgage Professionals are very excited. We're going to introduce our speaker, but I wanted to take a moment to introduce myself. Courtney's going to go ahead and mute everybody's lines. We are also going to go ahead and kind of cut everybody's cameras out as well too, so that our guest today can have the floor to speak. Please feel free to put any comments or questions you have in the chat. They'll be monitored by myself and our immediate past president, Linda Knowlton. My name is Nathaniel Bittman. I have a tremendous privilege and honor to serve as your state president here at the association. Thank you so much for your membership. We're grateful for that. We're kind of in trying, challenging times. Barry may talk about that. It is definitely a very unique environment. And the reason I wanted Barry to come out and speak today is I happen to be a subscriber of MBS Highway and have been for a number of years. And I have found that over the course of my career, especially during these challenging times that we see with rising rates, inventory challenges, I use MBS Highway tremendously. It has saved numerous deals for me. It helps me a tremendous amount when it comes to rate shoppers. I simply could not have done it with the education and the resources that I get from Barry and his team and the tools in MBS Highway. So I had asked for Barry to join us today to talk a little bit about the market, but also share with us some of the crucial tools that are available on MBS Highway, because I find that these tools are impactful and powerful for you. Also, for those of you that are members of the association, this is very important. If you're a member of the association, please keep in mind that you have an affinity. MBS Highway is very generous. Barry and his team are very generous. We have an extraordinary affinity program with a great discount for our members. You can get that on the website. We'll provide some information later. But at this point, I would like to take a moment to introduce a dear friend, someone who I think is just extraordinary and certainly a mentor in many, many ways. Barry Habib is the CEO of MBS Highway. He is an American entrepreneur and frequent media resource for mortgage and the housing industry. Barry wrote a book. It's an Amazon bestseller, #1 bestseller. It's called Money in the Streets. And I want to tell you, if you've not read that book, you need to read that book. And if you've read the book, you need to read the book again now, because what you're experiencing in this environment, there's a lot of content in that book that does relate to this environment, and it is really an inspiring read. So I recommend you read that again. Widely credited with saving the mortgage industry in 2020 from margin calls due to Fed actions, his presentation to the Fed created stability within a critical time. And I remember that a lot of us that are lenders and banks out there almost lost here in 2020. So thank you, Barry, for that work. 3-time Crystal Ball Award winner, Fannie Mae and Pulsonomics and Zillow for the most accurate real estate forecast out of 150 of the top economists in the US. 2019 Mortgage Professional of the Year, finalist of the Ernst & Young Entrepreneur of the Year, named to Mortgage Global 100 list, the St. Armand's Venture Businessman of the Year for 2021, named to the list of the 100 people to watch in 2023, and I wholeheartedly agree with that. During his mortgage sales career, Barry personally originated over $2 billion in residential lending loans. And by the way, that was at a different time, Barry, so those loan amounts were a lot lower, so significant accomplishment. He is the lead producer and managing partner of Rock of Ages, the 27th longest running show in Broadway history, which he also took around the world and turned into a major movie starring Tom Cruise. So check that out. He produced Chris Angel's Mind Freak at Planet Hollywood in Vegas. He is the highest rated speaker and trainer over 25 years in the mortgage and real estate industry. Princeton or somebody should give you an honorary doctorate, because you really are a great guy. So ladies and gentlemen, Barry Habib.
Thank you so much. That's very, very kind of you, first of all, Nathaniel, and thank you for everything that you do. Yes, you are a dear friend, and I appreciate you. And hi, everybody. I hope you're doing well today. This is a privilege to be with you. Love the fam group. You guys may or may not know this. I am domiciled in Florida, so it's where I'm right now. So big fan of the state that we live in. And let's talk a little bit about today what we can expect. So I'm going to share some slides with you. I'm going to go quickly. All I ask of you is to please focus, because we're going to go deep on some things. It requires you to be focused and engaged, but I promise you what you'll get out of this can be very valuable, not just to you, but to share with referral sources, clients. And what we're going to really do today is kind of stop selling and start solving, so we are more valuable to all of these relationships. And I think it is what's needed in this market, because when you take a look at at what is going on and what is happening in the marketplace over the past year or so, we see the population has changed of LOs. Now, I know that different companies have data. I think our data that we have at highway.ai is the best because we don't go by licenses, because licenses of the LO population can be deceiving. You may work at a bank or a credit union and not need a license, but be producing loans. Or you can have a license and not be producing loans. So therefore, are you really in the business? Well, for criteria, we just said, okay, in 2023, how many loan officers closed at least one loan? So that's to be qualified. 234,000 did. So of those 234,000, we took a look and said, in the past 90 days, how many of you closed a transaction? And what do we see here? Quite the significant drop. So 39% of LOs have now been gone from 2023. And from 2022, it's staggering. 51% of loan originators are no longer in the business. So first thing to you is congratulations, kind of like the Squid Games, you've made it to the next round. But what it also means is that your competition is a bit stiffer. So we have to raise our game and elevate our game. And that's really going to be the focal point of today's talk, is raising our game. If you want to know where you rank in the last 12 months, so we do this every month, we come up with updated numbers. We will have on Monday the new numbers as of the end of February, but this is the most recent numbers that we have. So if you want to know where you stand in the past 12 months, let's do loan count. If you did 2 loans, okay, you're in the top 94%. But believe it or not, 6% of originators have done only 1 loan. Of those that are counted, of the 143,000 that are counted, only 1 loan in the past 12 months. Now, how about averaging a loan a month? So did you do 12 loans in the last 12 months? Well, believe it or not, 40% of people failed that test. Only 60% of you have done 12 loans in the last 12 months. We take a look at 2 loans a month, just 38% of originators did 24 transactions in the last year. 3 loans a month, just 25% of you did it. 17% 4 loans a month. If you're doing 5 loans a month, you're essentially roughly in the top 10% of originators. If you do 10 loans a month, you're in a very rare company. You're in the top 3%. And if you want to know what it takes to be in the top 1% of originators in the United States, it is 15 loans a month in the last 12 months. You did 180 loans. Well, that puts you in very, very rare company. So now you know where we are. If we take a look at dollars, if you did 5 million plus, that's kind of like a 50-50 break point, where about 48% of people did 5 million plus. So kind of like a little more than half did less than 5 million in the last 12 months. 10 million, roughly a quarter. 15 million, just 1 out of 6. And then 20 million, top 10%. You do 20 million, you're in the top 10%. 30 million, you're in the top 5%. 45 million in the top 2%. 55 million, you're in the top 1% of originators. So there you have it, folks. That's what it takes right now to be ranked certainly amongst the top 1% of originators. So let's focus for a minute here on how much business is out there, because there's still a lot. And I know that business has changed, but look, what we talked about here is we said, okay, 15 loans a month puts you in the top 10%, top 1%. But if you could do 5 loans a month, you're in the top 10% of originators. So we know there's 388,000 real estate sales, of which 275,000 of them will have a mortgage. Now, these numbers are current numbers. They'll go up as the year goes on. But 31% of all transactions are refinances. So there's still 123,000 refinances being done out there. I know it's tough to do refinances, but please don't shortchange yourself and think that you can't do them. There's still 123,000. So look, team, there's still 400,000 chances a month. If you do 5 of them, you're in the top 10% of originators, just 5 of these. So let's focus on how we can do that. So let's understand that rates are a factor. So let's talk about the economy first and interest rates. We know that the Fed's told us many times, we got to see 2% inflation. So 2%, what's their measuring stick? It's called personal consumption expenditure, or PCE. And they want to take away energy and food prices, because not only are they volatile, but the Fed doesn't have much influence over energy and food prices. So what happens is that the Fed says, we'd like to see the core rate of PCE be confidently moving towards 2%. Okay, let's map it out. So right now, as we speak, it's at 2.85%. We've got the numbers through January. We don't have the February release yet. We'll get that at the end of March. So as we look at that February release, how is it calculated? So we're at 2.85. So as we get the number that comes in next month, which will be for February, it will replace February of 2023. So the replacement number goes away. So that means when we take the current rate minus February, the 11-month rate of inflation on core PCE will be 2.49%. So now we will add in our estimate for February of 2024 to give us 12 months. So that's going to be released March 29th. We think that comes in at 0.2%. That means the PCE year over year will likely move from 2.85 to 2.69. And while it's progress, not yet confidently to the Fed's 2%. So you can see why the Fed will have a tough time cutting rates. Let's move forward and kind of look through the calendar here. So if we just put a placeholder, and of course these estimates can change, but it's a reasonable placeholder to say 0.2% per month. So the first one that comes out March 29th for the month of February, as I explained to you, if it comes in at 0.2, it replaces the 0.36. That would put it at 2.69. And then the same thing for March, and that would bring us at about 2.5. So when the Fed has their meeting on May 1st, they're going to probably still be looking at 2.55, 2.6% year over year core PC. I think it's kind of tough for the Fed to say we're going to cut rates here. Now, what about the next Fed meetings? If we do the same math, you could see June, July gets a little better, September, but I think it'd be hard to get to the Fed's 2% target. I really do. So if that's the case, does that mean the Fed doesn't cut? No, it doesn't mean that. But I think what we have to really stay focused on is the key is going to be the job report. Because if inflation doesn't quite convince the Fed, if the Fed feels like, hey, the employment situation is getting worse, the job numbers are getting worse, they will cut rates and change their mind quickly. Now, remember, these are just placeholders and they can move up or down, but they're reasonable guesses. Now, the market kind of also has odds makers that tells you what the cuts chances are. So they think that there's a very slim to none chance later this month that the Fed cuts rates. And as I showed you, May 1st, with that inflation rate being at around 2.5, 2.6, not a great chance. But by June, they think that the chances start to really improve in our favor for Fed rate cuts. So that will be a welcome relief for us. So let's take a look at what the Fed is telling us. So the Fed does this anonymous dot plot. So there's 19 Fed members, and at the end of 2023, they all felt unanimously that the Fed funds rate should be between 5.25% and 5.5%. But in 2024, the Fed is saying, not unanimously, but some are saying one cut, some are saying two, some are saying three, some are saying four, one's actually saying six. But the Fed is telling us that they see some cuts coming in 2024. But what they're also telling us is they see more in 2025 and more in 2026. So you could see the downward trend here. So the point being, team, hey, congratulations, man. You went through the most difficult part, and there are better times ahead. Now, remember I said that the real focus for those Fed rate cuts could be the jobs market and the employment market. So let's take a look at what the Fed's telling us there. So just like the Fed says how many cuts there's going to be, they also tell us where they think the unemployment rate is going to be in 2024. And let's look at that. Three of the 19 Fed members say they think the unemployment rate will be 3.8 to 3.9%. 9 Fed members think 4 to 4.1. So if you take a look here, 12 of the 19 Fed members think the unemployment rate stays under 4.2%. What if it hits 4.2%? These 12 Fed members are going to say, oh my gosh, we were wrong. We got to start cutting more aggressively. So that's like a magic number, team, 4.2% unemployment. Now, the Congressional Budget Office, they've got a group of economists, and they come up with their best guess. And you know what they say? They say this year the unemployment rate should be 4.4. Now, man, if it hits 4.4%, then 17 of 19 Fed members are going to be surprised, and you will see rates decline rather rapidly. So just because there's talk right now that maybe the Fed's not going to cut as much or may not cut at all. Who knows? If inflation has not been cooperative as we'd like, and it hasn't, it really is up to the unemployment rate. And that's what I want you to be focused on. Because if that happens, we will see rates drop rather rapidly. Okay. So we just said that maybe rates come down this year. So what would our customer say to that? Maybe our customer who's looking to buy a home says, would it be smarter for me to wait because rates are going to come down? Now, you might already have a textbook answer for that. And it might be something like, well, you should marry the home and date the rate, right? I mean, that's a very cute saying. But what we have to do is put some real substance behind that, because I think it's a good idea to marry the home and date the rate. But unless we do the math, our customer just hears a cute saying. So here's what I would say to the customer. Okay, people say you should marry the home and date the rate, but let me explain what that means. It means buying the home today because there's benefits and then exchanging the rate, which could have some cost associated with it. But let's do an evaluation to see if the benefit outweighs the cost. So the first thing you have to understand is that a higher rate, interestingly enough, could actually be your best friend. And what I mean by that is the National Association of Realtors said that for every 1% drop in rates, and let's assume that we will get that you will see 5 million more people become eligible, which tells us that if 5 million more people become eligible, there's going to be even less inventory than there is today. And it's going to put upside pricing pressure on a home. So let's be specific. So we could pick any zip code in the country. And we do that at MBS Highway. And there's a tool we have. So look, if a rate, it doesn't matter what the exact rate is. It's just the differential. If you saw a rate of 6.75% today, and the rate a year from now would be 1% less than that, it could be 7 to 6 or 7.25 to 6.25, but whatever, a 1% drop in rates means that if you decided to marry the home or buy the home today, you would be paying a higher interest rate and have a higher monthly payment. Now, remember that we know that there's going to be appreciation too, and we have the appreciation forecast for every zip code. In this particular zip code, it's 4.2%. So if we're paying more in monthly payment, how much would that be for the year? Well, that would be $258 a month times 12 months is, let's call it $3,100. But there's also an additional cost of dating the rate, and that is the cost to refinance it, because then you're going to switch to the lower rate. So let's knock that in there too. And what you'll see is the overall cost to date the rate is about $7,100. Hey, that's an expensive date. But remember that 4.2% appreciation, that comes out to $34,000. So the benefit to marrying the home of $34,000 is more expensive than the cost of dating the rate. And when you net them all out, the reason why you should marry the home and date the rate is because it benefits you by $26,800. But without the math, it's just a cute saying. So it is a great idea to do so. We just have to explain it to people and show them the rationale behind it. So let's take a look back at our forecast that we talked to you guys about last year, because we did give you a forecast in early 2023. And we said that mortgage rates would start to decline in May. They didn't. And they'd be in the fives by summer. Now, they got into the very high fives. I think we had 5.9%, but they went up rather dramatically. Actually, it went up to 8%. So what happened there? What went wrong with the forecast? So what we did not see coming was this crazy debt limit deal that was put in place. Now, this was put in place by both the Republicans and the Democrats. They agreed to increase the amount of Treasury supply by debt by an astounding $2 trillion. Look, folks, it took our country 200 years to go $2 trillion in debt. The government in place put it together in 4 months. So that was a surprise. And as you could see here, June 5th, just when we thought rates might be starting to come down, the markets had to brace for $2 trillion of treasuries that had to be absorbed. And that extra supply coming to the market pushed rates higher. Well, the hits kept coming because after that debt deal, Fitch, the credit rating agency, downgraded our credit rating in the United States. And just like a customer, when your credit gets downgraded, you're going to pay a higher rate of interest for it. And that's what we suffered through. So it was a very tough period of time that we went through, and rates came down. But what do we see this year? Well, we do see that we see them going from, that 7% range towards the high sixes. And maybe we get into that mid to low fives if that unemployment rate kind of helps to be cooperative. And that's going to be the key here, is watching that unemployment rate. Do we get above 4.2%? Fed starts cutting rates start coming down. We could see that. So the Treasury yields should start coming down in the 10-year Treasury. We think the high of the year could be in that 4.4% range. We don't see it going above that. Right now, it's about 4.15. So and maybe even a little less, because I think that we've moved a little bit lower this morning to maybe 4.11. We think it'll move in the threes, and that could help us as well. So how do we make more money today? How do we gain market share? So let's start talking about that. So first of all, your customers, there's going to be refinance and purchase opportunities for move up, but your customers got to understand what is their true rate that they have. So we put this in our blended rate calculator, because the customer might say, okay, I've got a 3.25% rate, but do you really? Because if you have other debts, your rate on a real basis is higher. So for example, Mr. and Mrs. Customer, do you have a car loan? Well, yes. Well, if we put that in the calculator, now your blended rate, which weights it by the balance, you're really closer to 4%. And do you have any major credit cards? Well, yes, I do. Well, yeah, you know, you're at 5.8 with that. And do you have store credit cards? Of course I do. Well, you know, your real rate that you're paying is 6.5, and that's not very different than what's out there today. So folks, I showed you that statistic that there's 123,000 refinances being done every month. So 123,000. So if you're dismissing refinances, I think you're missing a big portion of the market. It's 31% of the market right now. So let's take a look at a true example here. This is a real case study. Somebody bought their home 4 years ago, 500,000 with a $400,000 loan. The value's gone up. The mortgage is amortized. But you're a good loan officer. You did their loan 2 years ago as well. And you refinanced them. You called them up. You said, hey, rates came down. Let's refinance. So 2 years ago, you did a 3.25% refi. So they got 28 years left. Their current LTV is 55, and everything looks good. Now, this might not be a customer you think is worth calling on a refinance, but they might be. Because even if the rates, let's call it 6.75, and the closing costs are $3,000, it might still pay to refinance if they have debt, if they have a car loan, they have a credit card loan. Because right now, their overall payment, remember, we want to look at their overall interest rate, and we want to look at their overall payment. So right now, they're forking over $5,700 a month between, even though principal and interest is low, and their taxes and insurance might be a good amount, their installment debt for that car loan, pardon me, and the revolving debt for their minimum balances on their store and major credit cards is costing them $5,700 a month. So what can we do to help these people? Well, the first thing is well, let's look at how much cash we could pull out. So even if you were conservative and look at a 75 LTV, you could pull out $132,000. We don't need all of that, but we could truly eradicate all this debt by checking these boxes off. And we wind up actually changing their monthly payment from $5,700 to $4,046 a month, or savings of almost $1,700 a month, folks. That's huge. That's life-changing. But here's where we can really be strategic and say, look, you're making the payments of $5,700 a month now. If you were to just simply say, let's keep my payment at $5,700, what would the magic be if we eliminated the debt and used all that excess towards principal on a new mortgage with me, even though the rate's higher? You see, I know when I was doing lots of mortgages, and every time I do a refinance, somebody would say, yeah, Barry, the only problem is I'm starting from 30 years again. I'm starting over again. And you probably can empathize with that, because I'm certain that many of your customers have that same concern. Yeah, I'm going from 26 years or 28 years or 24 years back to 30 years. So they feel like they're losing. But here, we're not going to do a 30-year mortgage. No, we're going to keep your payment the same, your overall payment the same. And the mortgage we're going to do is, believe it or not, a 12-year mortgage. Now you got 28 years left. So think about that. We're going to go from 28 years to 12 and keep your payment exactly the same, even though the rate's higher, by being smart with the debt consolidation. We're going to use that equity in your home wisely. So if we applied that towards principal, we do a 12-year mortgage, we save you 16 years and 4 months. And what does that mean? We're going to save 196 payments. That's a lot. Now let's break that down financially. So here's where you are today. You owe $362 today, and your debts for your credit cards and your car loan is $99,000. Let's total all this up plus closing costs and do a new all-in mortgage of $464. Now, 5 years from now, what do we look like? Well, 5 years from now, your balance on your existing mortgage, if you didn't do anything, would go down. Plus, you would have paid off the car loan, but you'd still owe $376. Now, if you do this mortgage with me and consolidate your debts and do it as a 12-year term, your balance goes from 464 to 315 in just 5 years, which means that you will have a benefit that's guaranteed and tax-free compared to if you didn't do anything of $61,000. Let's fast forward 10 years. It's amazing because 10 years from now, sure, this goes down what you owe, of course, if you didn't do anything, but look how much faster this drops. And you would now be in a position where you would only owe $107,000. That means you have a guaranteed tax-free savings of $219,000. And 12 years from now, when this mortgage is paid off, well, your benefit's $304,000. Yeah, because your revolving debt minimum balances never go away. And your remaining balance on your mortgage, while it will be lower 12 years from now, you still owe $248,000. I know you love that 3.25 mortgage, but man, you're going to love it a lot longer because you're still stuck with a big balance here. And while this is great to say we're going to guaranteed and save you tax-free $304,000, believe it or not, it actually gets much better than this because now 12 years down the road, what starts to happen? Well, what starts to happen is you go from no more payments of principal and interest here to still would have to make payments, in years 13, 14, 15, 16 here. So what does that mean? That 196 payments you'd save, we can calculate it. You'd save principal and interest and the revolving minimums. That comes out to, folks, $717,000 plus the consolidated revolving debt that you'd have. Here's your mic drop. You will be saving $774,000. And look, that's what you got to do today, team. This is stop selling, start solving, change people's lives. There are refinances being done today, 123,000 of them every month. People can benefit from us. The best way to approach this is with a plan of action that you just call your past clients. These are nice, easy calls. Spend 5 minutes. You're going to spend a half an hour a day. Why not call 5 people and say, hey, the last time we spoke, we saved rate, but this time let's try to save years and create wealth. Well, clearly that client's going to be interested in that. So if you listen to me and you call just 5 past customers a day, we know not everybody's going to qualify for this, but there are going to be people that have a lot of debt and they all almost certainly have equity. So if you said to them, let's try and save years and create wealth, I think they'd be interested. And in fact, we're hearing from so many people that they truly are. Now, at the end of the week, that's 25 people that you called, right? Just a half an hour a day is all I'm asking you to do. If you call 25 people at the end of the week, you're not going to get all 25, so don't get your hopes up. But what if you got one? That's extraordinarily high probability you'll get one. Team, that's $4,000. Could you use an extra $4,000? Of course. And help the people in the meanwhile? What if you did 2 out of the 25? What if you did 3? You do the math. We can use that extra money right now. Stop selling, start solving, just make the calls. Now, take this, practice it, do some samples, do it on yourself. But you could also start taking this on the road with your realtors because this will solve another problem. Remember, I want you to stop solving and start solving. Your realtor has a big issue right now with people that truly want to move up. They want to buy a home and they want to sell their own home, but they run into an issue because they have 3.25 on their current rate. And if the current market's 6.75, it's expensive for them because how do people sell their home today? I've got a home. I could sell it for $695. I owe $343 plus closing costs to sell $35,000. I've got $317, and that's what I'm going to use for down payment and closing costs on my new home. They all said that, this, okay, this is what they do. And if the closing costs are $12,000, that gives them a $305,000 down payment that they think they're going to push on the new home. Now, team, the best thing we have working for us here is they want to do this, but we all know that they get that payment shock, right? But think about the positives here. Think about why they want to do this. Well, they had a baby, or they need that room. They want a backyard, a garage. They want to work from home. They need a home office. All the reasons that make sense. But to accomplish this, to get it, they got to go up in price. So from their current home of $695 to get these things, they got to pay $850 for a new home. Minus the $305 that they're going to roll over means that they still have to take out a $545 mortgage at a 6.75 rate. Now you get payment shock, team. It's going to cost them $2,500 a month more. And this is where they say, oh, it's too much. I'm not going to do it. And the realtor is frustrated. The client is unhappy and you don't have a transaction. So let's stop trying to sell them and let's solve their problem. Your problem isn't that you don't want to buy the home. You want the home. Your problem is you need more room. You need a backyard. You need a home office, whatever it is. Let's solve for that. Let's get you that. but let's not have this big payment deficit. Because right now you're at a 65 LTV. Man, I could take you up higher. I could take you to an 80 LTV. And if I did that, I can raise your loan amount to 650,000. I could take you to a 77 LTV in this particular case, pay off all your debts. Now it only costs you $130 a month more to have the home of your dreams with the room for your child, the backyard you want, the home office you want, all the things you want for $130 a month. And that's what it comes down to. So you stop selling and you start solving. While your competition is going to visit your realtors with donuts, you're going in there with solutions. And that's what's going to propel you in this particular market. Now, there's another big problem that people have, and that's what we're seeing going on with low inventory. I'm certain that many of you have pre-quals, and you know, if you want to, you could just put in the chat that, yeah, you probably have a bunch of pre-quals you're sitting on, right? So this is a common problem. So team, let's hypothetical situation. I'm sure you've come up with this, right? So your realtor gives you a call with good news, but one of the clients you pre-qualified that they're working with finally in this tight inventory market found a home that checks off all the boxes. And it's hard. You know, maybe this one isn't what they wanted, doesn't fit, doesn't do that. They don't like this, they don't like that. But they finally found one that they really like. And the realtor convinced them, let's put in a full price offer. And they do that. So you say, great, yes, wonderful. But the next day, the realtor calls you up and says, oh, gosh, guess what happened? The deal fell through. Why? They got outbid. Now, what is your response? Because I'll tell you what the vast majority of mortgage professionals' response is. Oh, I'm sorry to hear that, but listen, I'm right here if you need me. Give me a buzz, Is that solving or is that selling? Here's what our response needs to be. Say, okay, I'm sorry to hear that, but listen, maybe we can fix this. Maybe we could save that home. Maybe we can win the home of their dreams for them. So give me a second here because I got all the numbers here. And let's go over the scenario. So you're saying that the current price is $630 that they're asking, and they put in a full price offer of $630. So give me a second here. Let me pull it up in AVM so I could see the value is $630. So okay, we know that's okay. And let me look at the numbers and see what's going on. Now you told me that they got outbid. Somebody bid $640. Yep. So in order to win this home, they got to bid $645 or $15,000 over asking, right? So let me see if the math makes sense. Guess what? I can get them to qualify and I can get them enough down payment. They can make it work at $645. Yeah, Barry, that's the only thing is though they don't want to go $645. They think it's too much to go $15,000 over asking. So that's the problem. So, okay, well, let's help them understand if it's a good thing to do or not. Let's evaluate it for them. So the first thing I have access to is appreciation in every market. So what we want to do is two things for that customer. One, let's ask the question, how long will it take for them to break even? In other words, yeah, the home's worth $630 today. How long until it is worth the $645 they're paying? Because it might surprise you. You see, in this zip code, I know the appreciation for the next year, and the appreciation for the next year is 4.01%, which means it will take 4.9 months to break even. That's not very long, but also think of it this way. When are they closing? Well, they're going to close in about 45 to 60 days. Well, guess what? That means it's going to be like 3 months after they close to break even. Realtor says, that's not a long time at all. Now, remember I said there's two questions? One was how long will it take to break even? The second one is how will they fare in the future? How much money can they make, let's say, in the next 5 years? And fortunately, we could see that. Look, we know the 5-year forecasted appreciation, roughly 4.3%. We know historically for the last 63 years, it's been 4.5%. So it's right in line with that. But the thing that I want us to take a look at here is that this is not an easy thing to solve for, because if I were to ask any one of you listening, right, say, hey, 4.28% compounded annually on a $630,000 value for 5 years, what's that number? It's difficult to do. That's why we got to calculate it. And when we do, would it surprise all of you? Would it surprise that customer and realtor that the value is $783,000? Now, they're paying $645. So $783 minus $645 means a very handsome profit of $138,000. Wow, Barry, maybe they should go $645. See, it's a whole different story. And yeah, Mr. and Mrs. Realtor, we can even show you the journey. Of course, they start off $15,000 undervalued today, but 4.9 months from today, or about 3 months after they close, they're even. And then after 1 year, 2 years, 3 years, 4 years, 5 years, you could see that journey. And I'll be happy to co-brand this with you. And look, if you haven't been on our Facebook page, people put these up there all the time, just showing that this is helping to close deals. Why? Because they're solving, they're not selling. This is a solution. I'm not selling you here. I'm showing you why you will create wealth and taking you on that journey. We know your competition's stiffer. This is what you got to do. So let's take a quick look here at another big one. A lot of people saying, hey, it's unattainable to buy, we're going to rent, all those things. But I know you have ways to get that customer in the home. But the main obstacle is their mental attitude towards it, because they think that either housing market's going to crash, they think that renting's cheaper and it's a better idea, but it's all short-sighted thinking. Let's look at an example. So imagine a $500,000 home, 450 mortgage, 7% mortgage rate. The monthly payment's $4,400. If you were to compare it to renting, it'd be roughly $3,600, it'd be about $800 a month cheaper. Now, rents on renewals are going up 5% a year because landlords have a little extra pricing pressure. If the property was vacant, landlord wants to get some money in. But on a renewal, landlords can pressure people a little bit more because they know that it's a pain in the butt to move and it's expensive to move. So it's cheaper to pay an extra 5% a year, so people suck it up and they pay it. So we have to understand how that relates to this equation. They think they're going to be in home for 9 years, so we'll look at it over a 9-year period. Now, what we're going to do is we're also going to talk about all the negatives here. So the annual property taxes will likely go up. Let's account for that. On average, let's say 2%. And then one of the nice things about renting is that the landlord will pay for most of your repairs. So let's take into consideration your out-of-pocket repairs. So that's about $2,500 a year. And then another nice thing about renting is you don't have to worry about the cost to sell. So if we even put in a 6% cost to sell and threw that in there on top of it, and of course the closing cost to buy, let's put all that in there. The one thing that's really good about buying is appreciation. So in this zip code, we got 4.13% appreciation. Historically, in this particular zip code, it's been 4.2% over the last 63 years. So we've got a lot of data here. Let's tie it together. Now, if you were to look at the payment difference, like I said, almost $800 a month difference, because the cost to buy is much more expensive than the cost to rent. Then what we're going to take a look at is breaking that down. So here's your graph. In year one, the cost to buy is more expensive than rent. But hold on a second. You see this black portion here? That's not really a cost. That's principal. So you can see it's pretty close. By year two, it's even closer with principal. By 3, it's about even. Now, year 4, you are actually more expensive renting when you consider principal than buying. And on a cash flow basis, you're more expensive year 6, 7, 8 renting. What if I put it all together? Your total renting over the 9 years, you're going to spend $483,000. That accounts for that 5% per year rental increase. If you were to buy, accounting for the taxes going up, it's about $480,000. So believe it or not, cash flow, you're actually cheaper to buy than rent by about $2,000. Now, while that's nice, the real benefit comes in the fact of this black portion here, which is your amortization. You see, your amortization, let's take a look. In year 1, you're going to amortize $4,500. In year 2, $9,500. By year 9, you're going to be amortizing $55,000 total because you bring your starting loan amount from $450 down to $395. That's a huge amount of benefit. Hey, and what about that appreciation? Remember we talked about that 4.13%? It doesn't seem like a lot, but it is. It's $220,000. And then you also get a benefit from your taxes because that interest that you're paying, that interest, there's a benefit there. But we're going to tell you the benefit with the correct calculations, but we're going to tell you the benefit net of the benefit you would have gotten on your standard deduction if you rented, because you still get a benefit. So your benefit over the standard deduction is $20,957,000. So this is your tax benefit over renting. And the cost to sell, let's account for that too, of $43,000. So what is your overall benefit here? Well, your overall benefit, when you take it all the factors into consideration, it's $245,000 over the 9 years. And you can see each year how it goes up, up, up. Now, when we take a look here at what this would look like on a co-brand, it's a beautiful piece. and it would show you all the benefits to doing this each and every year. I think that this is something you got to share with your customer. Now, what about the housing market overall? So let's quickly take a peek at the housing market. You can see when people want to compare it to a bubble, one of the things they forget is that in 2007, there were 4 million units in inventory. Today, there's a million. Our population in 2007 was 301 million, and today it's 340 million. So we have seen our population go up by 39 million while inventory has gone down by 3 million. How can you have a bubble? You also have to take into consideration the inventory minus what's already under contract. There's only 665,000 active listings. Take a look at what that stands compared to pre-COVID. It is less than half, less than half. So inventory remains very tight. We see transactions rising by 15 to 20% this year, and we see appreciation nationwide being about 5% this year. So 5% is strong. One of the things you may want to do is you may want to get the word out. I don't know if you've seen me on the American Dream show, but if you wanted to get your own segment on American Dream, they have me do the opening. I talk to a lot of people that do the local markets, and they're doing very well because you could highlight a realtor, you could highlight a listing, you could get the word out and get your own notoriety. If you want to just hit that QR code, it's a great way for you to gain exposure and talk about these topics or gain more referral sources. I only tell you this because it works and people tell me. I have nothing to do with the company. I just share it because I know it's an idea that works. Now, a couple of quick points. We said appreciation would be 5%. That might not sound super exciting, but it is. Because if you had a $500,000 home and you put 10% down, that'll be a $50,000 investment. Now, the other $450,000, yes, you have to finance it, you have to pay. But conversely, we know that it's going to be similar. If you were to be renting, you'd have to pay to also live someplace like this. So 5% appreciation on a $500,000 purchase is a $25,000 profit. A $25,000 profit on your $50,000 investment means you're getting a 50% rate of return. Please remember that. It's not just 5%, it's much greater. And what would I be doing today? I'd be doing things that would be a little more creative. I would be approaching my realtors and saying, hey, first of all, there's a AVM that I can do. And what I would be doing is saying, before you go on your next listing, let me show you a map of the neighborhood and show you the value of every home, including the subject property and what the subject property is worth. Let me give you an interactive map with all the comps to save time for you. Let me give you a neighborhood report. This is just creating value. It takes you 1 minute to do on our site. And then I'd also give you a real estate report card, which shows you appreciation, which shows you the historical levels. It shows you what the supply demographics are. It shows you the median household income, the affordability, the rental situation, age demographics. This gives you so much. And, you know, in the great book, The Art of War by Sun Tzu, said every battle is won or lost before it's ever fought. Remember, I want you to solve instead of sell. So rather than just say, here's some bagels or donuts, how about if you walked in to a realtor's office really prepared to win? So if it were me today, I would use the technology to, if I wanted to target a realtor, and you could do that with us, you could see realtor production so you know who you want to go after. And then I would say, let me look at some of their active listings or recent sales because I want to trigger their reticular activator. I want them to be engaged. And then let me take the 5 minutes to create a buy versus rent. Let me create a AVM. Let me create a real estate report card. Let me create an appreciation report. So now when I go to see that realtor, instead of giving him a bagel, I mean, you can bring a bagel if you want. I could say, here's what I'm doing for top performing realtors. And I took a few minutes to show you what it might look like for you. And maybe you might want to show this at an open house, bring this to a listing appointment, show it to a prospective buyer to help them see the opportunity. I can help you do this. If you'd like, we can work together. It's a lot more powerful than a bagel. And it's what the originator of tomorrow has to do. And we do that for MBS Highway and list reports. We have a great offer for you guys at FAMP. Nathaniel was kind enough to mention it, but it's an enormous discount. It's essentially a 40% discount. And instead of it being $199 a month, it's $119. Listen, I know money's tight, but team, this is what we got to do. How much would it hurt, to lose a deal for $119? And you will get deals. If you want to do it, simple, email Sasha, S-A-S-H-A, Sasha at mbshighway.com. You have to go through there because if you go to the site, it's $200 a month. Here, you'll save the 40%. And if you wanted to do it annual, it's even cheaper. But take a look at that. And team, if you wanted to stay in touch with me, I am Barry Habib, or the QR code on Instagram. And, I wrote the book Money in the Streets because it's about understanding how to find opportunity. It's all around you. Even in this market, team, I believe opportunity is all around you. Nathaniel, I know that I actually almost came in exactly on time. I went 2 minutes over, so I
You,
apologize for that.
you could have, listen, you could have all day and night. We'll give you the floor as long as you're willing to give it to us. I appreciate it.
Oh, thank you.
That
Thank
was really, really terrific. One question in particular popped up. James Vinny, who's also an MBS Highway user as well too. Can Barry comment on the possibility of the Fed slowing QT?
Yeah, so the runoff of quantitative tightening is very restrictive, and they're offloading from their balance sheet, which now stands at $7 trillion, down from $8.5 trillion. They're getting rid of about $90 to $95 billion a month. So that has to be absorbed by the market. That's very restrictive, but without getting too technical here, it's been masked by something called reverse repos. There's been a lot of money, like in a piggy bank, in these reverse repos. That's gone from $2.5 trillion out of $441 billion. So we've seen that really come down. So the effects of QT haven't really been as painful. But in the next couple of months, that $441 billion will be gone. And you'll start to really feel the pinch from this quantitative tightening. The Fed is aware of this, and they have slated it as a discussion topic on their March 20th Fed meeting. It'll be very important to see the results of that. And I'm sure in the press conference, they will be asked about it. What will the Fed do with the runoff of their balance sheet? I think at some point this year, they're going to have to slow the reduction of their balance sheet. That means less supply coming to the market, and that's good news for interest rates. So let's keep a close watch on that. It's an excellent question. It's a very astute question. So yeah, we will definitely be watching that very carefully.
Thank you. Thank you, James, for that question. Another question from Didier Malaviz. Do you see an event happening this year that can change all of that? Something like March 2020, cybersecurity. I think by March 2020, I'm referring to.
It's always hard, that would be COVID, and then the other things, like, the banking crisis that we saw in March, April of 2023, that they put that bank term lending facility to kind of salvage that. But things can happen when you start tinkering with this stuff. You can get these. They're hard to see coming. But yes, it can cause the Fed to act. The economy is fragile. So could something happen? I think it will be more the job market. I think that will be the one that will cause rates to move. So it's not the initial jobless claims. That's the last one. So following that is a fool's game, because there's severance pack. It's the last thing to happen. People are hoarding employees. Then there's severance that could last for months. And then there's, quite frankly, a lot of individuals who are making $180,000 a year, that it's almost demeaning for them to apply for $300 a week in unemployment benefits. So, I wouldn't necessarily look at the initial claims. I think that's a fool's game. Most of the top economists know that. But I would be looking at the unemployment rate as one that will make the Fed take notice.
Thank you. That's a great point. Any comments on where we might expect to see the 10-year yield versus the 30-year fixed spread start to normalize?
Yeah, I think they'll get closer. We did see that start to happen, as we saw the 10-year drop earlier this year, before some of those less friendly job numbers, the January job report and the unemployment. January is just a tough month for us between those baloney job numbers that we saw from the BLS. So yeah, the spreads should improve a little bit too. So that's a good question, and I think that we will start to see that. I know we get back down to normal spreads, but we should come off of the higher spreads that we're witnessing, which is around 3% right now. It should get back down to 2.5%. We were there in like December, so friendlier Fed talk will do that. Presentation slides, many of them are in MBS Highway. We don't share them. But team, thank you, Nathaniel. I appreciate you. Have a wonderful, wonderful, wonderful afternoon, everybody.
Thank you so much. And just want to remind the group, one more time that become a member of the association. Today is Barry Day. So Barry Day means that we have a one-day special until midnight, and that special means that Today, your membership is $99. If you're not a member, you get a third discount. We're taking you from $149 down to $99. So just today, you make sure you go on to become, just type in the word Barry in the code. If you're an affiliate, then it's Barry affiliate, and you get that special membership just for today for $99. In addition to that, these slides, all of these things, they are in MBS Highway. So you need to subscribe to MBS Highway, and you need to use all of these tools. I will tell you as living proof, I use these tools. They make a difference. People will call me to come attend open houses because they want me to create these flyers and bring them over. And it creates a high level of rapport. When you're talking to a sophisticated consumer, and Barry mentioned it, I love the line you used, Barry, here. You said, you know, we talk about marrying the property and dating the rate. I love what you said. Without the math, it's just a good saying. So really, really good point. So make sure that you're subscribing, make sure that you're getting your membership at MBS Highway, get your discount, and get out there and start becoming a consultant. So as Barry likes to say, you know, stop selling and start solving.
Thank you, guys. Be well, everybody.
Thank you. Thanks, Barry.
Bye.
Bye.